Retiring at 65 could be costing you hundreds of thousands of dollars. And here's exactly why financial experts are calling this traditional retirement age a massive financial mistake.
Hey everyone, I'm here to completely flip your perspective on retirement timing, because what I'm about to share will fundamentally change how you think about leaving the workforce. We're diving deep into why waiting until 65 to retire might actually be sabotaging your financial future, the hidden costs nobody talks about, and 3 real-world scenarios that prove conventional retirement wisdom is seriously outdated. Stick around until the end, because I'm breaking down a simple 5-step strategy that could literally save you from making this expensive mistake. And if this helps you rethink your retirement plan, smash that like button and subscribe for more straight talk financial advice that actually makes sense. Let me start with something that might shock you. The concept of retiring at 65 isn't based on what's financially optimal for you. It's a number created by Otto von Bismarck in 1880s Germany, back when life expectancy was around 47 years old. Today, with people living well into their 80s and 90s, clinging to this outdated retirement age is like using a horse and buggy on the interstate.
Here's what's really happening when you automatically assume 65 is your retirement target.
You're potentially leaving massive amounts of money on the table through something called delayed retirement credits.
For every year you delay claiming Social Security past your full retirement age until age 70, you earn an 8% increase in your monthly benefit.
That's not 8% total. That's 8% per year, which compounds to a 32% increase if you wait from 66 to 70. But here's where it gets interesting and why timing matters so much more than you think. Social Security is just one piece of a much larger puzzle that includes tax diversification. Think of tax diversification like having different types of investments, but instead of stocks and bonds, you're spreading your retirement money across different tax treatments. You want some money that's already been taxed, some money that will be taxed when you withdraw it, and some money that grows tax-free forever. The problem with the traditional 65 retirement mindset is that it doesn't account for the massive tax implications of your withdrawal strategy. When you retire at 65 and immediately start pulling from your 401k, you might push yourself into higher tax brackets unnecessarily, especially when Social Security kicks in. Over 20 years of retirement, that's an additional $153,600, not counting inflation adjustments.
Meet Sarah, a 58-year-old nurse from Ohio who's been contributing to her 401k for 30 years.
Sarah always planned to retire at 65 because that's what her parents did. She has about $600,000 saved and figured she'd start drawing Social Security and her retirement accounts simultaneously.
But here's Sarah's story that changed everything.
Sarah's financial advisor showed her the math. If she retired at 65, she'd receive about $2,000 monthly from Social Security.
But if she kept working until 70, that same benefit would jump to about $2,640 monthly.
That's an extra $640 every single month for the rest of her life. But Sarah had another realization. Those 5 extra working years meant 5 more years of high earnings going into her Social Security calculation, potentially pushing out some lower earning years from her calculation base.
Plus, she could continue contributing to her 401k, potentially adding another $100,000 to her nest egg.
Sarah's story shows how working longer isn't just about delaying benefits. It's about maximizing multiple income streams simultaneously. Now let me introduce you to Marcus, a 55-year-old small business owner from Texas who represents a completely different scenario.
Marcus has been self-employed for 20 years running a successful plumbing business.
Unlike Sarah, Marcus has been contributing to a SEP IRA and has built substantial equity in his business. But his Social Security benefits will be lower because he paid himself minimally to reduce payroll taxes. Marcus's story unfolds differently. His retirement strategy involves selling his business, which could generate a significant lump sum. But the timing of that sale, relative to his Social Security claiming, creates a tax nightmare he never considered. If Marcus sells his business and claims Social Security in the same year, he could push himself into the highest tax brackets and trigger taxes on his Social Security benefits that could otherwise be avoided. Marcus learned that by carefully timing his business sale, potentially spreading it over multiple years, and delaying Social Security until 70, he could save tens of thousands in taxes while maximizing his monthly income. His story illustrates how retirement timing affects business owners completely differently than traditional employees, and why the 65 rule makes even less sense for entrepreneurs. Finally, meet Jennifer, a 62-year-old divorced teacher from California who's facing yet another unique challenge. Jennifer has been contributing to both a 403(b) and a Roth IRA, but she also receives spousal Social Security benefits from her ex-husband's work record. Jennifer's situation demonstrates the complexity of modern retirement planning that the simple 65 rule completely ignores. Jennifer's story gets complicated fast.
She can claim spousal benefits as early as 62, but at a reduced rate.
However, she can also delay her own Social Security benefits until 70 while collecting spousal benefits.
This strategy, called claiming restricted application for spousal benefits, allows her to essentially double dip in a way that maximizes her lifetime benefits.
But here's where Jennifer's story gets really interesting. By working until 70 instead of retiring at 65, she can continue contributing to her Roth IRA, which has no required minimum distributions, and can be passed tax-free to her children. This creates generational wealth that retiring at 65 would have prevented. Jennifer's story shows how retirement timing affects not just your finances, but your family's financial future. These three stories share common threads that expose the biggest flaws in traditional retirement thinking. First, they all show how the interaction between different income sources creates opportunities and pitfalls that the 65 rule ignores. Second, they demonstrate how working longer isn't just about earning more money, it's about optimizing the timing of different financial decisions. Third, they prove that retirement planning has become too complex for simple rules of thumb. Here's the reality nobody wants to talk about. The government has been systematically raising the full retirement age because they know people are living longer and the system needs adjustment.
If you were born after 1960, your full retirement age is already 67, not 65. Yet most people still anchor their thinking around 65 because that's what they grew up hearing.
But there's another hidden factor that makes retiring at 65 particularly problematic right now. Healthcare costs. If you retire at 65, you become eligible for Medicare, which sounds great until you realize that Medicare doesn't cover everything. Medicare Part B premiums, Medigap insurance, and prescription drug coverage can easily cost several $100s monthly, and these costs are rising faster than inflation. When you factor in healthcare costs with reduced Social Security benefits from early claiming, many people find that retiring at 65 actually reduces their disposable income compared to working longer. This is especially true for higher earners who face Medicare premium surcharges based on their modified adjusted gross income. The tax implications get even more complex when you consider required minimum distributions from traditional retirement accounts starting at age 73. If you retire at 65 and start drawing from these accounts immediately, you might create a tax burden that pushes you into higher brackets when RMDs kick in.
Strategic retirement timing can help spread this tax impact over more years.
Recent policy changes have made this timing even more critical. The Secure Act 2.0 has created new opportunities for retirement savings, including higher catch-up contribution limits for people over 60 and expanded access to Roth conversions. These changes favor people who work longer and can take advantage of these enhanced savings opportunities. Let me break down a simple 5-step approach to determine if retiring at 65 makes sense for your specific situation. Because this isn't about working forever, it's about making informed decisions. Step 1 is calculating your break-even point for delayed Social Security claiming. Take your estimated Social Security benefit at full retirement age and multiply by 8% for each year you delay until 70. Compare the cumulative payments over your expected lifetime to see if delaying makes financial sense. For most people living past age 78, delaying Social Security increases lifetime benefits. Step 2 involves analyzing your total tax picture across all income sources. List your traditional retirement accounts, Roth accounts, taxable investments, and projected Social Security. Map out how withdrawing from each source affects your tax bracket, and consider whether Roth conversions during lower income years could reduce future tax burdens. Step 3 requires honestly assessing your health and family longevity. If you have significant health issues or family history suggests shorter life expectancy, claiming Social Security earlier might make sense despite the reduced benefits. However, don't underestimate your longevity, as people consistently underestimate how long they'll live. Step 4 means calculating the true cost of healthcare coverage. Research Medicare costs, including premiums, deductibles, and coverage gaps. If your employer offers retiree health benefits, understand exactly what's covered and how much you'll pay. Healthcare costs often surprise new retirees who assumed Medicare would cover everything. Step 5 involves creating multiple scenario plans. Model what happens if you retire at 65, 67, and 70. Include all income sources, taxes, healthcare costs, and inflation adjustments. This isn't about finding the perfect plan. It's about understanding the trade-offs so you can make informed decisions based on your priorities. The reality is that retirement planning has become too individualized for universal rules. Your optimal retirement age depends on your health, family situation, career satisfaction, financial position, and personal values. Some people should absolutely retire at 65 or even earlier. Others would benefit financially from working longer. What's dangerous is automatically assuming 65 is right for you without running the numbers.
The difference between optimal and suboptimal retirement timing can easily amount to hundreds of thousands of dollars over your lifetime. Money that could provide better health care, more travel, increased charitable giving, or larger inheritances for your family.
The key insight is that retirement timing affects much more than just when you stop working. It influences your tax liability, healthcare costs, Social Security benefits, investment growth, and estate planning. These interactions create opportunities for people who plan strategically and costly mistakes for those who follow outdated rules. Remember, working longer doesn't necessarily mean working full-time in your current stressful job. Many people transition to part-time work, consulting, or entirely new careers that provide income while being more fulfilling. The goal is maintaining enough earned income to delay Social Security claiming while optimizing your overall financial strategy. Your retirement timeline should align with your financial goals, not arbitrary age-based rules created over a century ago for completely different economic conditions. Take control of your retirement planning by understanding these interactions and making decisions based on your specific situation rather than conventional wisdom that might be costing you dearly. If this breakdown helped you see retirement timing differently, give this video a like and subscribe for more financial reality checks that put money back in your pocket. What's your target retirement age, and are you rethinking it after watching this? Let me know in the comments below.